There is a question Melbourne families sit with longer than almost any other money question. Should we keep renting or should we buy? Most people frame it as a values question. Security versus freedom. Commitment versus flexibility. That framing misses the point. The real question is a numbers question, and when you run every number honestly, the answer is more interesting than either side of the debate usually admits. On an $850,000 South-East Melbourne property, a realistic entry price in suburbs like Noble Park, Springvale, and in 2026 owning costs around $5,300 a month all in. Renting an equivalent home costs around $2,200 a month. That is a $3,000 monthly gap. That gap is the real question. Where does it go and does it ever pay off? Most people budget for the mortgage repayment and nothing else. On an $850,000 home with a 20% deposit, that is a $680,000 loan at 6.2%, $4,153 a month. But that is not the full cost. Add council and water rates, home and contents insurance, and the maintenance allowance. The real number is closer to $5,300 a month. That is the figure your household needs to be able to carry, not the mortgage number alone. The maintenance figure is the one that surprises most first-time buyers. The industry rule is 1% of the property value every year. On an $850,000 home, that is $8,500 per year. Not on anything dramatic, just the ongoing reality of a hot water system, a fence panel, a gutter, and appliance. In older Southeast Melbourne housing stock, the first 5 years of ownership often run closer to 1.5% as new buyers fix what the previous owners deferred. Before the monthly costs even begin, there is the upfront wall. 20% deposit on $850,000 is $170,000. But then stamp duty in Victoria for first home buyers at this price is over $45,000. The full concession has phased out above $600,000. Add conveyancing, building inspection, and lender fees, you need around $218,000 in the bank before you get the keys. Not just the deposit. Here is the mechanism that makes buying powerful. Melbourne property has grown at around 5 to 7% per year over the past 30 years. At a conservative 5% annual growth, well below the long-run average, that $850,000 property is worth $1.385 million at year 10. Your equity at that point after the loan balance is around $800,000. That is the lever that makes buying the stronger financial outcome over a long hold. There is a second advantage that gets discussed less. Every mortgage repayment includes a principal component that builds equity. Nobody can access that money or spend it. That is forced saving, and it is more powerful than people. Most people find it significantly harder to consistently invest a spare $3,000 a month than to simply make a mortgage repayment. The discipline gap is real. The case for renting is real, but it only works if the $3,000 monthly gap goes somewhere specific. If a household that rents takes $215,000 in equivalent deposit and upfront costs and puts it in a portfolio, then invests $3,000 a month consistently, the maths is genuinely competitive with buying for the first 6 years. A 4% net return on that strategy puts the renting household neck and neck with the buyer around year 7. The problem is that most people do not invest that gap. It goes into lifestyle. A better car, more eating out, a nicer holiday. None of those things are wrong, but they do not compound. A renter who spends the monthly saving rather than investing it does not arrive at year 7 ahead of the buyer. They arrive at year 10 with $280,000 paid in net rent and nothing to show for it. That is the worst outcome in this comparison by a long distance. There is a non-financial dimension that matters for Melbourne families with children. A landlord in Victoria can end a residential tenancy with 60 to 120 days' notice in most circumstances. For a family whose children are enrolled in a specific school zone, that notice can mean a disrupted school year and lost. Owning removes that risk entirely. For families with roots in a particular suburb and a school preference to protect, that tenure security has real value that a spreadsheet cannot fully capture. Here is where the model lands. At 5% annual capital growth and a 4% net return on the renting and investing strategy, the buyer and the disciplined renter arrive at almost identical net wealth at year 7. Before that, the renter who invests is slightly ahead, dragged down by the buyer's stamp duty and early interest burden. After year 7, capital growth on a leveraged property pulls the buyer clearly ahead. If Melbourne grows at its historical average of 6 to 7%, that crossover compresses to around year 4 or 5. Buyer equity at year 7, $584,000. Renter portfolio at year 7, $585,000. Essentially the same, that is the crossover. Hold the property past that point and capital growth pulls the buyer ahead. Sell before it and the renter who invested comes out in front. 3 questions narrow the right answer for your household. First, do you plan to stay in the same suburb for at least 7 years? If not, buying is unlikely to recover its upfront cost. Second, can your household service the full $5,300 a month mortgage, rates, insurance, and maintenance without financial stress? 42% of gross household income going to housing is already above the stress threshold. Third, if you rent, will you genuinely invest the monthly gap every month for a decade? If the answer to the third question is honestly no, you know you will spend the monthly saving rather than invest it, then the renting path does not produce the financial outcome the numbers suggest. The worst outcome in this comparison is not buying at the wrong time. It is renting for a decade without investing the gap and arriving with neither property equity nor a portfolio. Whatever choice your household makes, make it with the full numbers in front of you. This is general information only. Property markets, interest rates, and tax rules change. Before making any rent or buy decisions, speak with a licensed mortgage broker, a financial advisor, and a conveyancer. The numbers here use published figures for 2026. Verify them at the source before acting.